Let us start by defining accounting. So we have a couple of definitions of accounting, but we will go with the most prevalent one, which is defined by the American Association of Accountants. The American Association defines accounting as identifying, measuring, recording the transactions of the business, which will help users to take decisions and make informed choices. We also have the Merriam-Webster's definition, which is there on your screen, which essentially captures the same essence that the American Association says. So, ideally, accounting is recording of transactions, presenting them in a particular form, whereby the users can make informed decisions and they can make choices. Let us introduce certain concepts and certain terminology. These concepts and terminology will be used throughout the discussion and they are core and crux of the accounting discipline and accounting subject. Let us understand some key terminologies. So we have assets, liabilities and owner's equity. That is the core three concept which will be used throughout, and this understanding is pivotal if you want to learn accounting. So assets are the resources owned by the company. These assets will help the company to generate cash flow, or these assets will help the company to prevent cash outflow. So they will be either generating cash inflow or they'll be preventing the cash outflow. Then comes liability. What are liabilities? Liabilities are commitments or debts owned by the company which the company has to pay. These liabilities can be in various forms. They can be notes payable, they can be debts, they can be liabilities which the business owe towards bank, and they have a lot of form. Last we have called as the owner's equity or the common capital. This owner's equity will consist of the money that is brought in by the owner or the money that the owner has raised in order to run the business. Now we have a concept called as accounting equation in accounts. This is again a fundamental concept whereby you can see that the assets will be equal to the owner's equity plus the liability. Let me repeat it. The assets will be equal to the owner's equity plus the liability. Now, when we say that the assets will be equal to the owner's equity plus the liability, let me explain that with an example. Say a company wants to buy a office building for say $100,000 or 100,000 Indian rupees. Now, if the company wants to buy a office building for $100,000, where will that money come from? That money either can come from the investment that the owner introduces. So the owner has to bring in his money of $100,000 to buy the asset, to buy the office building, or he may take support from one of his friend or a bank or a financial institution in order to compensate or in order to contribute for that $100,000. Now here the office building which is bought by the owner will be the asset, and the contribution that the owner himself brings, let us again dissect that example and we say that the owner is having only say $30,000 and the owner brings $30,000 as his contribution. This will be the owner's equity, and if he borrows $20,000 from a friend of his, this will be a loan from the friend. The balance $50,000 he may take support from a bank or a financial institution. This would be the long-term debt which he is borrowed to buy the office building from a bank. So if we'll see the accounting equation, it says that asset should be equal to liability plus owner's equity. Here the asset is for $100,000. This would be equal to the owner's equity, which is $20,000, plus the liability, which is $30,000 from the friend and the $50,000 from the bank. This completes the equation where the left hand side and the right hand side would be equal and they would be $100,000.